Hey traders, welcome back to another Liquid FX YouTube video. Here we're going to be going over one of the most important topics in SMC, so smart money concepts, but it does have parallels to ICT. We're going to be going over how to choose the A+ POI. So we're going to be looking at rules and we're going to be looking at confluences, two things that you should master before entering the markets from a POI or smart money concept perspective. So what do I mean by that? Let's dive into two aspects. So first we're going to start with our 3 rules to a POI, right? And then we're going to go into some confluences, right? Some add-ons, right? Some extra confluences, right? But first it's important to start with the rules. So when it comes to a POI, let's start with a bearish example, right? So if we have a POI in this region, right? We need to see 3 things for a POI to be validated, right? Very simply put, we need to see 3 things, right? Now, if we're in a bearish climate, we've got bearish structure. The first thing we're going to be looking at is our structure, right? So what do we want to see? We want to see price break structure to the downside. So we want to see a clear break of structure or a shift of structure, right? BOS, break of structure. So that's the first thing we want to see. And that's represented here with an arrow. So this arrow represents a shift in structure, right? So the last low, whether it's the daily, the 4-hour, whatever time frame you're looking at, we need to see a shift in that swing structure represented by this break of structure arrow over here. The second thing we want to be looking at is we want to be looking for correct pricing, right? So we want to be looking at our PD arrays. So if we're selling, we need to be selling in the premium, right? Above the 50% level. So our PD arrays are very important to look at. So how do we mark out our PD arrays, right? Now, simply put, a PD array will be taken from the swing high, the most recent swing high, down to the swing low. This here is how you determine your PD arrays, right? So your PD arrays represent 2 areas in price. They represent premium up here, I'll label that P, and it represents a discount down here, and I'll label that D. So it's important to understand when we're looking for potential sells in price, we need to be looking above the 50% level in the premium. So that's important to understand. Now the third and final rule is very important. This is more from an ICT basis. We need to see a fair value gap or an inefficiency in price. Very important to see that fair value gap or inefficiency. So the reason why we need to see that is because we want to see price head up to the premium in order for us to mitigate something. So if I draw out our POI like this, so the POI will be in gray, not yellow, in gray. So now that we've seen our POI in this region over here, this is what our POI is typically going to look like. Our POI must satisfy these 3 rules to the left of your screen. There must be a clear break of structure. It must be priced in the premium when we're looking for a bearish POI. So we see it priced above the 50% level in the premium, and it must leave a fair value gap. So there must be a fair value gap or an inefficiency in this region, right? So there must be an inefficiency, and I'll label that in blue. So this blue box represents an inefficiency in price. So with these 3 rules being met, what are the confluences? What are those add-ons that we're looking for in price that also make our POI more high probability? Now, a lot of it comes down to liquidity. Now, what do I mean by liquidity, right? Liquidity often comes in the form of inducements. So if I just take this to the side for a second, if we have a POI like this, right? If this is our POI, so if I bring that back to gray, if this is our bearish POI, we've seen price displace from it, giving us a fair value gap in this region. So now when we see price head up, do we want to see price shoot right into the POI like this? Or a better example would be like this. Do you want to see price simply shoot up into the POI like this? Or do you want to see price give us a slowdown just below the POI before tapping into it? Now the answer is the second one. What we want to see is we want to see a build up or an engineer of liquidity just below the bearish POI. And the reason why we want to see that is because we want to see the market engineer liquidity for it to be swept, for it to go in the other direction. And this is what's meant by inducement. So this is inducement. What do I mean by inducement? Inducement is very simply liquidity dropped above or below a POI. Above in this case because it's a bearish POI. So what we see is we see price displace downwards, and from here we see price head up into the premium, generating liquidity in this form over here. So this is equal highs. Equal highs over here, equal liquidity. So this here is a liquidity pool, right? This red line over here represents a liquidity pool in price, right? So why does that make this POI a higher probability? The reason why it makes it a higher probability is because we have our inducement. So when price engineers liquidity, taps into the POI and sweeps this liquidity, this gives us a further confirmation to see lower prices. Okay, and it's also important to notice that while we have a generation of a buy side liquidity, we also have equal lows, sell side liquidity. So understanding liquidity is your main vehicle when it comes to increasing your chances of catching a high probability A plus POI. So if we bring this back to our original example, our POI must do the following things, right? Because we have our rules marked out over here. We have our rules to the left of the screen. So let's see how we can apply them to this schematic. What we're going to see is we're going to see price break the previous low, giving us a break of structure. And then as we see price head up, we want to see it slow down, generating some form of liquidity, right? Before tapping into the POI and continuing lower, right? So what we see over here is we see our three rules being met with a break of structure, a premium in this case, and a fair value gap or an inefficiency. And we see inducement, liquidity being dropped near the POI, which represents an area of inducement, and that's what we're looking for, just above the POI in this case. So if I take you down now to the charts, we're going to have a real look at this. Just one example I plucked out from euro dollar. Let's see what we see. Let's dissect this chart. So what we see over here is we see a bullish structure that shifts trend to the downside, right? So we see a break of structure just over here, right? So this last low over here, if we zoom in, gets very clearly violated. So this is a violation of structure, or a break of structure for short. And this represents an area where we could be looking for potential buys. So with that being said, we have a swing high up here, right? So we have a swing high up here, and we have our swing low down here. You could argue the swing low could be here as well, but for argument's sake, I'll just keep it here. Same thing, it works out to be the same. So now that we have our swing high and swing low, we have a confirmed break of structure. Now what's our next rule, right? If we just pick our rules over here, we need to see a break of structure, we need to see a fair value gap, and we need to see it being priced in the premium, right? That's our premium discount array. These are our three rules over here. So we have a swing high up here, and we have our swing low down here that's been established. If I zoom into price, you will see a fair value gap here in this region, right? This is our fair value gap. So our three rules have been ticked. We have the equilibrium over here. So this is our equilibrium level, the 50% level. So anything above the equilibrium is essentially the premium range of price. Premium, okay? So we have a fair value gap, and we're priced in the premium with a break of structure, right? So our fair value gap will indicate where our order block will be. So, our POI will be. So this here is a point of interest that fits the requirements. This is a POI, or a point of interest. So if I scan this over to the left of the right of your screen, we see price tap into this POI and give us the rejection that we are currently looking for, right? So this is how you could have got involved in. This is a higher time frame trade that you could have got involved in, targeting inefficiencies over here and inefficiencies over here, right? For a nice 1 to 4, 1 to 5 hour trade. Now let's look at one of the confluences we discussed, which is inducement. So what we see is we see price aggressively tap into the POI in this region over here, marked out in yellow. So this is a yellow POI. So what do we see over here? We see a massive generation of a buy side liquidity, right? In the form of a trend line, right? Trend line all the way over here. So this is a huge ton, a huge, massive ton of liquidity that's being produced in this market, right? That gets mitigated, that gets swept as this POI gets mitigated. This is what makes this POI such a high probability, right? It meets all of our requirements. It breaks structure. It leaves a fair value gap. It's priced in the premium, and we see it generate a huge amount of liquidity before it gets respected. This is inducement, everyone. This here is inducement, IND, inducement. Okay, so that is a bearish POI, a high probability bearish POI. So the same thing applies when it comes to bullish POI. We just flip the ideology on its head, right? We just flip the ideology on its head. So if I take you to the price action now on GBP USD, we see the exact same thing forming, right? This is now on the 15-minute for GBP USD, right? It's the same exact principles. Where what do we have over here? We see our most recent structural high get broken to the left. So this high here is essentially broken all the way up here. So what we've seen here is another break of structure. So that's our first rule. That's our first rule, as we can understand. We have a break of structure which represents a shift in the market direction. So let's get our three rules out again. We want to have a break of structure. We want to have a fair value gap. And this time we want to be priced, you guessed it, in the discount, because the discount is where we look for buys below the equilibrium. So that's the first rule that's been ticked, which is a break of structure. Now, we swing. We take our Fibonacci tool from the swing low all the way up to the swing high, right? So this also represents an area of premium versus discount, right? Now, you guessed it. The last rule is to look at where the inefficiencies lie in price. So here we have an EQ, or an equilibrium. Anything below the equilibrium is a discount. So we understand we're in a discount range, okay? Now, with that being said, can you spot the POI? It's exactly where the fair value gap is. So this here is our fair value gap in price. We see price inefficiently deliver buy side delivery, right? We see an inefficiency. The wicks here don't touch. So our POI essentially becomes this area over here, because price has a reason to go lower into this region. It's an inefficient delivery of a buy side. Inefficient buy side delivery, right? So this then becomes our POI, and the POI will be in gray. So this POI, again, is valid for the fact that it follows our rules. It breaks structure, it's priced correctly in the discount, and it leaves a fair value gap. And again, you can see the result of that. Just follow a simple POI selection. We see a nice 1 to 4, 1 to 5 hour trade, following the same rules of break of structure, fair value gap, and PD arrays, along with liquidity, right? Let's have a look at our inducement. What do we see over here? What we see over here is we see 1 low, 2 low, 3 low. So what we see here, we see a triple low that gets formed in this region. This triple low is a form of inducement. And this is a triple low over here. So this is just simply equal lows, right? This is just equal lows. So when we see this, we understand that price has an incentive to build liquidity just above the POI, sweep the liquidity as it taps into the POI, and then continues higher. And this is very classic of your high probability A plus POIs. This is an A plus POI, following the same rules and narratives of liquidity, structure, timing, and PD arrays. So if you like this video, give it a like, give it a thumbs up, and I look forward to seeing all of you in the next one.